Welcome everybody to the webinar, ASUs effective in 2018, brought to you by GAAP Dynamics. This is our standard slide, basically saying that we are not accountants, but we play one on TV.
Oh, that's not true, Mike.
No, Chris and I have made every possible...
We are accountants.
We are accountants, we are CPAs, and we've done everything to make sure that this training is up to date.
Yep.
However, at the end of the day, compliance with US GAAP, SEC regulations is your responsibility. My name is Mike Walworth. I'm the founder and CEO of GAAP Dynamics, and with me today is my friend and colleague and business partner, Chris Brundrett. But instead of looking at our mug shots, which I don't know how old that was, let's see if we still look as young as in those pictures. So, hey, Chris.
All right. Hey.
Hello, everybody.
Welcome, everyone.
What we'll do is during this webinar at different points, especially when Chris and I are babbling about accounting and class discussions, we'll turn on this video so you're not just looking at a blank screen. As mentioned before, I'm the founder and CEO of GAAP Dynamics. Many of you know us. I know that I can see many of our clients are on attending, so thank you guys very much. If you aren't experienced with GAAP Dynamics, thank you for joining. Our company has been in existence since 2001. We're a bunch of ex-Big Four auditors, and we go around the world giving accounting training. For 17 years, basically, it's been in the live format. Although we've given webinars for our big accounting firm clients and our multinational clients, this is the first time we've ever done it on an open basis for our own clients. And so we very much appreciate you guys joining us. We had 250 people, over 250 people sign up. So thank you very much. At the end of the day, you will get CPE credit. So enough about that. With me today, as I mentioned, is Chris Brundrett. Chris, say hello to the world.
Hello, everyone, and thank you for being here today. I am the Chief Operating Officer and Chief Financial Officer of GAAP Dynamics, and also spend a lot of time in the classroom facilitating. Very excited to be here on this webinar. Awesome.
Well, without further ado, let's get started. We're going to be covering 16 ASUs today. That's a lot. And we've divided them into 8 different topics, as you'll see in a moment. But really, because this is in an open format, we really had to make sure that we covered everybody, from public business entities to also private entities.
Even if you're not-for-profits thrown in there. Right?
Exactly. And so, this is all the ASUs, except for one, we'll get to that in a moment, that are effective in 2018 for somebody. Okay, now, not all of them are going to be applicable to you, but by the end of the seminar, what we hope is that you can at least recall the ones that are applicable and be able to figure out whether or not these ASUs are and what impact they'll have on your company.
And I think that's a really important point. In the webinar today, short amount of time, what we hope you take away from this is an understanding of what the ASU is all about and whether or not it's applicable to your company. And if it is, certainly there'll be more research and that'll be necessary in order to comply with the ASU. But there's a lot of great information out there.
Yeah, and so this webinar format, again, it's not new to us, but it's new in this realm. But we are giving this is a new service offering for us for our clients, and actually some of our clients that have signed up for this service offering are actually hopefully joining us today. So welcome everybody. We'll talk to you later in the year when we give a webinar for your company. As we said, we're going to cover 16 ASUs and the following 8 topics. Now, before we get to this, I just want a reminder. The NASBA makes sure that you're still alive. We hope you're not multitasking. We hope you'll be, attentive enough to listen. But just in case, we have to do several polling questions in this webinar. I'm sure you've taken webinars before, so you're no stranger to that. But it's very important that you answer all the polling questions. I think there's about 6 or 7 in this webinar to make sure that you're still engaged. And if you don't answer it, we're unable to give you CPE. So, don't say, well, I didn't get my CPE certificate. Well, it was because you were multitasking. I'm sorry, my friend, I cannot help you. But answer the polling questions. We'll give you about 10 to 15 seconds for each one. Mariah, our organizer, is there, and she will kind of monitor to make sure, and then we can sort of remind you guys, hey guys, wake up, it's time to answer a polling question. But without further ado, let's get started with our first polling question. Thank you very much for letting us get an understanding of you. We might want to give them a little bit more time. Do we have 100%? Okay, we had 100%. So good. Thank you all for joining us. So looks like when we look at this poll, you see the percentages there. Thank you for letting us kind of understand you. A lot from industry, right? 53%, 63 if I could. Again, I said I'm not a CPA, I just play one on TV. 63% from industry. So welcome you guys.
And a good split between private and public entities.
Yes, so good. So that means that the ASUs covering both. I'm glad we did that.
Right.
But anyway, thank you guys very much. That's the first polling question. One of the things that's interesting is, we said we're covering 16 ASUs, and I saw revenue-related issues, but I didn't see revenue recognition. And as you guys are no doubt aware, probably the biggest change this year for public business entities is ASC Topic 606. This standard prescribes a new 5-step model applicable to all companies, to all industries, and to all transactions. It is a big, big deal. However, Chris and I talked about it. And Chris, what did you tell me?
There is no way we can talk about ASC Topic 606 in an hour-and-a-half training along with the other 16 ASUs. And I think that's okay. We have other training available on ASC Topic 606. It's certainly something you want to spend, half a day or a day, even just scratching the surface. It's a big deal. We have other trainings available on that. It's not something to be taken lightly in a really short webinar. And I think the other reason why we took this approach is our clients and others out there in practice, we know are really into this new standard, and many people have implemented or in the process of implementing it. And we didn't want you to forget about these other 16 ASUs that are becoming effective. Very easy to do when you're dealing with something as massive as the new RevRec standard. So that's really the point of this webinar, is say, hey, don't forget about these others because they may have an impact on you.
Yeah, and as Chris mentioned, we do have other trainings. So I know for certain regional firms, we've given a day-long or a half-a-day training workshop on revenue recognition. We've gone into companies and tailored a workshop just for them. And as we'll mention towards the end of the webinar, we are offering, or we're going to launch an online learning platform, and we will have a revenue recognition track in there. So, without further ado, let's get started in our ASUs. First topic, Business Combinations, ASU 2017-1. Now, before we jump into this ASU, we need to I wanted to give you guys, what's the big deal, right? The WIFM. There is a difference between a business combination under ASC Topic 805 and an asset purchase. Now, probably the biggest difference is that in an asset purchase, there is no goodwill. The purchase price is allocated to the identified assets and liabilities based on their relative fair values. This is a huge difference between Topic 805, where you have to determine the purchase price, fair value all the assets and liabilities, with the residual being either goodwill or a bargain purchase in which it's going to recognize into income immediately. Probably another huge difference is the treatment of contingent consideration. And with regards to the contingent consideration, under a business combination, you need to fair value all your contingent consideration in a business combination and continue to remeasure it each and every period. Whereas in an asset purchase, there is no real specific accounting for that. What they end up doing is they end up basically determining either when it's a done deal or under topic 450 when it's probable and reasonably estimatable. So listed on the screen is kind of all those differences, but that's why it matters. And this new ASU, basically talks about what is a business. In other words, is it in the scope of topic 805? The definition of a business is an integrated set of activities capable of providing a return.
That hasn't changed, has it?
No, that definition is not, it's the same. Mm-hmm. However, under the old guidance, there are three elements of a business, right, Chris? We have inputs, processes, and outputs. Now, outputs are not required to be present to meet the definition of a business, but an entity needs to evaluate whether that set of assets, the set, is capable of being managed as a business by a market participant. What's really changed under the new ASU is to be considered a business, we need to have an input and substantive, that's the key, substantive processes that together significantly contribute to the ability to create outputs. Another difference is that if you don't have all the, under current guidance, if you don't have all the inputs and processes that a seller needs to operate the set, it can still qualify as a business as long as a market participant could replace these missing inputs or processes. However, under ASU 2017-1, the board eliminated this requirement for market participants. So it made it easier. They basically took it away. Long story short, what's going to end up happening is less transactions are going to be businesses. Now, if you remember, I remember, Chris, you and I were going throughout the world basically saying, oh, you bought a building? It's probably a business. It's probably a business.
So much stuff got caught up in that definition that really didn't make a whole lot of sense from an economic perspective. And I think that's part of what drove this change, right?
Yeah. And so under ASU 2017-1, the first thing we need to do is kind of look at a screen and basically say, is substantially all the fair value of the gross assets acquired concentrated in a single asset or a group of similar assets? Okay. So in other words, you're buying a building, mm-hmm. and basically you're paying for a building. If the answer to that is yes, then it is not a business. And that's very important because it's outside the scope of topic 805. No goodwill, no fair value and contingent consideration. Now, substantially all is not defined in GAAP, but generally speaking, anytime that language is used, we generally think about 90%. Now, if substantially all of the fair value is not attributable to assets, then basically we need to look at the outputs. Does the acquired set of activities include outputs? If the answer to that is yes, then there is 4 conditions within the ASU, only one of which needs to be met in order to qualify as a business. If none of the conditions are met, you don't have a business. Now, if the acquired set of activities does not include outputs, then basically 2 criteria need to be present in order to qualify as a business. Now, this ASU is applicable this year for public business entities. All other entities have 1 year in order to adopt this. And you see the transition on the screen. Now, for each ASU we're going to cover today, we will have a screen like this, okay? But we're not going to spend time going through the effective dates and transition. They're available for you, right? I mean, we've made it available for you, and these are available in the handouts. And so in your participant pane from GoToWebinar, under the handouts tab, you will see the handouts, and these are the slides that we're covering today. You can download those, and then they'll be there for you. The other thing I want to mention right now that we've covered one of the 16, is the ability to answer questions. Now, if questions come up, feel free to, in the question pane, write your question down. Now, we will not stop the webinar at any point, or we will not stop the webinar immediately to answer everyone's question, but at various points within the webinar, we will stop it. We'll get Mariah to kind of give us a flavor of the questions, and we'll try to answer them. If we do not get to the answer, and this is what I think is going to be interesting with us, Chris. I think we're maybe different from some webinars, is Chris and I will actually take all those questions, and what we'll do is we'll try to answer them and then publish a frequently asked questions or the questions during the webinar and try to get back to you when we give you your CP certificate and all that stuff. So anyway, so next on the list is taxes, and I'm telling you, you are in good hands with Chris. He loves taxes.
One of my favorite topics.
You've been doing tax training since you started 12 years ago.
Yeah, that's right.
For our major client. And so I believe anything about taxes is you. So I think I should turn it over to you.
Sounds good to me. Well, there's two ASUs related to income taxes that we're going to talk about today. And the first one is, well, kind of a crowd pleaser. This is something that's actually making life a little bit easier. It deals with the classification of deferred taxes. Now, historically, before this ASU came out, anyone who prepared a classified balance sheet was required to classify their deferred taxes, so those are deferred tax assets and liabilities, as current or non-current. Now, there are and were netting rules allowing you to net current deferred tax assets with current deferred tax liabilities and non-current with non-current, but only within the same tax jurisdiction. What that meant was, if you had a larger company that operated in many tax jurisdictions, you may have 4 line items on the balance sheet all related to deferred taxes. And so you can take a look here at this example company, and they have current and non-current deferred tax assets. They also have non-current deferred tax liabilities on their books. So a lot of information there on the balance sheet. And what the FASB has done with this ASU is basically said, no more do we have to do this. All deferred taxes will now be classified as non-current. Okay? And that helps clean up the balance sheet a little bit, make the presentation make a little bit more sense, and it alleviates any issues with trying to determine whether or not a deferred tax asset or liability is current or non-current.
And then, but do we still have the netting?
We do still have the netting rules, and it's the same. That really hasn't changed. So you can net your now all non-current deferred tax assets and liabilities, but again, only if they're arising within the same tax jurisdiction. Okay. So still a company that's larger, multiple tax jurisdictions, will have probably 2 line items on their books for both deferred tax assets and deferred tax liabilities.
And doesn't this is sort of getting us in line with another accounting standard out there?
It does. We do try, FASB tries, to align us with IFRS whenever possible. And this was one that IFRS has always had non-current deferred taxes. So this does align us with IFRS. And again, it just makes life a little bit simpler. So I thought that would be a good one to start with. Crowd pleaser here.
That's easy.
Related to taxes. Effective date, time is now for all other entities. This was effective last year for public business entities. The next one we want to talk about, this is dealing with intra-entity asset transfers.
So within the same group.
So you have a transfer of an asset between one subsidiary and another, let's say. So you're within the same control group, and you have an asset that is sold, let's say, from one subsidiary to another. And we've made a pretty significant change to the accounting for these transfers under ASU 2016-16. So let's take a look at this example on the screen. That'll help highlight what the accounting used to be and what it's changing to under this new ASU. So you can see on, I guess before we even get into the details overall, if you think about this, companies must eliminate any intercompany balances, transactions, and profit or loss on transfers of assets if those assets are remaining within the group, and this happens during the consolidation process. However, intercompany transfers of assets between subsidiaries in different tax jurisdictions will have tax consequences, and we'll see that here. So usually these transfers are taxable events for the seller, because generally they're selling the asset for more than it's on their books for. And they're also events for a buyer. We have a new tax basis, and we may have deferred taxes result. And so let's take a look at this example on the screen. We have sub A and sub B. Assume they're wholly owned subsidiaries of the same parent. Sub A and sub B reside in different tax jurisdictions. They file separate tax returns. Sub A's tax rate is 15%, while sub B's tax rate is 35%. Sub A currently has an intangible asset on its books with a carrying value of $1 million. Sub A sells that intangible to sub B for $1.5 million. Okay, what this means is sub A has a gain on the sale. Sub B now has a new tax basis in this asset on its independent books of 1.5 million. What is the proper accounting for this intercompany asset transfer, assuming the asset remains within the consolidated group at the end of the period? Well, current guidance or historical guidance, depending on your effective date, under US GAAP prohibited the entities from recognizing any income tax consequences on this asset transfer. That meant that the seller, who's sub A, had to defer any net tax effect until the asset was on-sold outside of the consolidated group. The buyer, sub B, was prohibited from recognizing a deferred tax asset on that basis difference that just got created, the 1.5 million versus the 1 million. And so all the tax effects were basically deferred. And that has been the historical requirement. Under ASU 2016-16, this all changes, and now entities are required to record the tax consequences in the period in which the transfer takes place, even if that asset's staying within the group.
So whether you're selling it outside the group or inside the group, it's the same.
It all stays, right? We recognize the gain, and we'll see, all the numbers for our example here in a minute. Now, very important point. This new guidance applies to all inter-entity asset transfers except for inventory.
Okay.
And that may be a big one for many companies where you're selling inventory between subsidiaries and it's still on the books of the consolidated group at the end of the period. This doesn't apply to inventory. Inventory, we still are required to defer all the income tax effects like we've done historically.
Until the inventory is on-sold outside of the group.
Exactly.
Gotcha.
And that's what triggers the tax recognition. Okay, so let's take a look at our example. And this is applying the new guidance, because remember, this wasn't inventory. This was an intangible asset. So we fall under ASU 2016-16. So sub A in this example is going to recognize current tax expense of $75,000. They had a $500,000 profit. Okay, they sold it for 1.5. It was on their books for $1 million. Multiply that by 15%. Here you go. They've got current tax expense of $75,000. They're going to recognize that now. Sub B has a deferred tax benefit, a deferred tax asset of $175,000. New tax basis for them of $1.5 million. That's what they paid for the asset. But in the consolidated group, the original tax basis stays the same. It's $1 million, right? So there's a deferred tax asset that gets created here, and that will now be recognized by sub B on their books. We have a temporary difference of $500,000. We multiply that by 35%, which was their tax rate. Voila, there's our $175,000. Now, what is the effect on the consolidated financial statements of the parent at the end of the day? So in consolidation, all this stuff's eliminating, and here you go. But at the end of the day, we have a $100,000 impact to net income, because we had expense of 75, we had a deferred tax benefit that goes through the P&L of 175. So we have a net effect in the consolidated financial statements of 100,000. So that's a hit, a positive hit in this case to the P&L. We would have never had that under the old guidance. So that's kind of the end result of this change. But remember, not for inventory transfers. So we'll highlight that here on the next slide. We've already talked about the current tax treatment. There you go. And then the new tax treatment, again, applies to all intra-entity transfers except for inventory. Okay. Why did the FASB not include inventory? Well, what they realized was it might be a lot more burdensome to companies, because a lot of times these are really, a lot of transactions, and they're very fast a lot of times. So
they settle pretty quickly.
Yeah, meaning it gets unsold outside of the group relatively quickly.
Okay.
Right. So, it's sold from one sub to another sub processes, it gets on sold to the customer in pretty short order. So they just decided, cost benefit, it might not be worth it to apply this. So that's a little bit about this ASU. It might apply to many of you out there anytime you have transfers of assets between subsidiaries in different tax jurisdictions.
Perfect.
An effective date, this is time is now for public business entities.
Okay, perfect. All right, next up, we're going to talk about financial instruments. There's two ASUs here, although the ASU 2018-3 basically just sort of quickly amended the first one. So let's get started. The summary of the impacts. So, there's four main impacts that we're going to talk about here with regards to this ASU 2016-1. We'll spend more time on the last one, so we'll do that last. The first one I want to talk about is the idea of fair valuing liabilities. Now, Chris, do you remember? I mean, this was my shtick for a while, and maybe some of you out there that have seen me in the classroom remember. I would always talk about only in America. So the Don King, only in America can you recognize a gain from becoming a crappier company.
Yeah, that was always a good one.
And I would show the, certain companies' financials, and I would show it because basically when you're fair valuing assets and liabilities, anytime you're fair valuing it, you have to consider credit risk. If it's an asset, you're going to consider the counterparty credit risk. If it's a liability, however, you need to consider your own credit risk. And so if I have a payable to Chris, and Chris has an asset on his books receivable from me, if I pay Chris and I become a crappier company, but I'm fair valuing my liability and he's fair valuing his asset, your asset goes down in value.
Right.
So that means you're going to have a loss if it's going through the P&L.
But you have a liability which also goes down.
And my liability goes down, and I'm not good with numbers, but that means I have to debit the liability and credit, income.
Right, because remember, this is fair value option, so fair value through the P&L. So that credit to reduce that the offset to the reducing that liability goes through the P&L.
Yeah, and every time I would do that, I would explain it, and people would be like,
That's crazy.
Yeah, and no one liked it. So the good news is the FASB's done away with that. And they said, listen, if you are fair valuing liabilities under the fair value option, any changes in your own credit risk should go to OCI, other comprehensive income, not P&L. Now, this is only applicable for liabilities under the fair value option. If you're fair valuing liabilities because you have to, a la derivatives, that change in fair value, all changes in fair value are going to go to the P&L, not OCI, unless it's part of a valid hedge relationship, of course. The second change,
taxes again,
related to this. So get this. So if you have a deferred tax asset, ASC topic 740 makes me determine whether or not that I'm going to get to realize that deferred tax asset, right? Looking at 4 sources of possible income.
And if not, you're going to record a valuation
allowance. And so what some companies were doing is, let's say they had an unrealized loss on a financial instrument, an investment, like a debt, bond. And that unrealized loss created a deferred tax asset. And so let's assume this company really wasn't that great with their other 4 sources of income.
Didn't have a lot of future taxable income.
And so the auditors, or they decided that they needed a valuation allowance. Well, what companies were doing is they'd say, well, wait a second, I can prove that that unrealized loss is sort of temporary, and that whole other than temporary thing, it's temporary, and I'm going to be able to hold until recovery.
Because they're saying, even though I don't have future taxable income, this is a debt security. I could hang on to it until it matures, and effectively, it's gonna, it's
gonna come back to its par or whatever.
Right.
And so, if they made that assessment, then what they were doing is saying no valuation allowance on that piece of deferred tax asset.
They were stripping it out and looking at it separately.
Yeah, and the FASB said, nope. You do all your valuation allowance and your assessment of deferred tax assets together. And so if you need a valuation allowance, that includes all valuation allowance. You can't strip out different pieces. The third thing that this ASU changed, Chris, was this ability, you always had to fair value all your financial instruments, even those that were carried at amortized cost. Now, this might have been held to maturity debt securities. This might have been, non-marketable equity securities. And so what they said is, well, wait a second, first of all, non-public companies, that's a little burdensome. Forget it. You don't have to do any disclosures anymore for amortized cost type investments. None. For public business entities, you still need to do fair value disclosures on your amortized cost investments, but you don't need to disclose the significant assumptions and judgments anymore. That was these are probably level 3 fair value measurements. Anyway, let's just forget it. You don't have to do it. So really this ASU made the disclosures easier. But probably, or at least, I don't know if it's the biggest, I think it's the biggest. It's the one I get excited about, is this new accounting for equity investments. So equity securities. Remember under old GAAP, they were going to be trading or available for sale. Well, that's gone. There's no more trading, no more available for sale for equity securities. In addition, there's no more OTTI assessment. And so I want to spend a little bit of time, if we could, Chris, covering this equity securities.
This is a big piece.
Okay. So under old GAAP, all debt and marketable securities were under the same topic, Topic 320, trading, available for sale, and held to maturity. Non-marketable, if you didn't have a marketable security, that was probably at cost under topic 325. However, ASU 2016-1 basically created a brand new codification topic. That is ASC topic 321. So, okay. So we're answering a question here. This new well, the software is not new. It's go to webinar. You can only do one thing at a one time in the pane. So the question out there, I see Mariah has answered it. The questions for CPE, there's been one. I think we have 5 or 6 of them. We have 6 of them. I think you have to answer 5 of them. So just a reminder, those polling questions will be up. We've had 1 so far.
Got a few more chances.
You got a few more chances. So as I was saying, topic 321 is the new topic for all equity securities. So now you got topic 320 for debt, topic 321 for equity. Now, the first thing we need to determine is whether or not we are in the scope of ASC topic 321. First thing we need to ask ourselves is, does specialized industry guidance apply? Things like accounting for investment companies, broker-dealers, pensions. Those specialized accounting basically say everything is at fair value through the P&L. And so therefore, topic 321 doesn't apply. However, if the entity holding this investment is not in a specialized industry, then we need to determine whether or not the investment meets the definition of an equity security. An equity security is any security representing an ownership interest in an entity or the right to acquire or dispose of an ownership interest in an entity at fixed or determinable prices. If the answer to that is yes, then we're in the, we're probably in the scope. If no, we're probably going to apply other GAAP. That probably is topic 320 because it's probably a debt security. The last thing we need to consider is it outside the scope? Outside the scope, obviously you're not going to use the new guidance. Things like derivatives, equity method investees, consolidated subs, things like that. So what's in, Chris? What's in the scope? Things like common stock, non-redeemable preferred stock, and ownership interest in mutual funds. And there's some things that are out too, such as mandatorily redeemable debt, preferred stock, cash settled options, things like that. Now, the overall key to this accounting that we're about to go through is whether or not the equity, remember, already in scope, so equity security, does the equity security have a readily determinable fair value? What that means is this: it's traded on an exchange listed with the SEC, New York Stock Exchange, American Stock Exchange, or NASDAQ, or an over-the-counter market that regularly provides bid and asked quotations, such as the NASDAQ or other OTC over-the-counter markets. It could also be listed on a market with the same breadth and scope. So foreign markets with the same breadth and scope of a U.S. market would be considered readily determinable. And finally, the other thing is, if it's a mutual fund or a structure similar to a mutual fund, the fair value is readily determinable if the fair value per share or unit is determined and published and is the basis for current transactions. Now, this is important because if it has a readily determinable fair value, then the only option is fair value with unrealized gains and losses through the P&L. If it's not readily determinable fair value, then we have to go through this decision tree. And what we've done is, rather than me go through the decision tree, our digital marketing and learning specialist, Mariah, has produced a little video. So we will play that now.
The subsequent measurement of investments in equity securities depends on answering the following questions. First, does the investment have a readily determinable fair value? If yes, the investment is subsequently measured at fair value in the statement of financial position. Any changes in fair value, otherwise known as unrealized holding gains and losses, are included in earnings each period. If the investment does not have a readily determinable fair value, the next question is whether or not the investment qualifies for use of net asset value, or NAV, as a practical expedient to fair value. If an entity qualifies for use of NAV as a practical expedient, and the entity intends to utilize this expedient, then it should follow the guidance for the practical expedient set out in ASC 820-10-35-59. However, if the entity qualifies for use of NAV as a practical expedient, but decides, for one reason or another, not to use it, the investment is subsequently measured at fair value in the statement of financial position, with changes in fair value included in earnings. Going back to our second question, if the entity does not qualify for using NAV as a practical expedient, the last question is whether or not the entity elects to use the measurement alternative set out in ASC 321. If the entity intends to use the measurement alternative, the investment should be measured at cost, minus impairment if any, plus or minus changes resulting from observable price changes in orderly transactions for the identical or a similar investment of the same issuer. If the entity does not intend to use the measurement alternative, the investment is subsequently measured at fair value in the statement of financial position, with changes in fair value included in earnings. We'll start by exploring the term readily determinable fair value.
Okay, well, thank you. I think that was good. It's a little bit better than me. So basically, the only time you apply this measurement alternative is if the equity security does not have a readily determinable fair value and does not qualify for use of NAV as a practical expedient. Now, since we're here, I said I wasn't going to stop it, but I do like this question. The question that came in was, what about a mutual fund that invests solely in fixed income securities? And I love this one because it's actually a class discussion in our live training, and it's in several of the Big Four accounting books. You don't look through the investment. In other words, you have an ownership interest in a mutual fund as long as it meets the definition of an equity security, because it's an ownership interest, then regardless of what it invests in, it's still an equity security and not a debt security. So the answer to the question that was asked is a mutual fund investing all in fixed income securities is still an equity security, the underlying shares itself. Now, go ahead.
You own the shares in the mutual fund.
Right.
Right.
Now, if we do apply for this, or we do qualify for this measurement alternative, now the important thing is it is an alternative. You don't have to do it. You can always go fair value through the P&L, okay? But if you qualify for it and you elect it, then you might apply this measurement alternative. It starts with the cost, and then every reporting period, you need to qualitatively assess whether or not it's impaired. Okay, if it is impaired, if you qualitatively assess that, yes, it might be impaired, then you need to write it down to fair value at that date. But you don't need to do impairment each and every period. You don't need to calculate it. Now, if you don't have any impairment, then fine. The last thing that goes into this carrying amount is observable price changes. Now, these are transactions in the same or similar security of the same issuer. Now, you don't need to do an exhaustive search, but you do need to take your blinders off and actually do something and look for these observable price changes. Now, if you have the observable price changes, then that carrying value goes up or down. Okay? Now, what about when do you stop the measurement alternative? Well, first thing is if you've chosen this, you must stop if you no longer qualify for it, because the security has a readily determinable fair value or it qualifies for use of NAV as a practical expedient. However, even if it still qualifies for the measurement alternative, the last ASU, dealing with financial instruments, basically says you can stop. You can have an irrevocable election to stop using the measurement alternative, but that means fair value through the P&L forever for that security, all similar securities of the same issuer. Okay, so it really is if you stop, you're out. All of these ASUs are applicable for public business entities this year. Now, let's do a polling question. We were asking, this is the second polling question. Remember, you have to answer the polling question to get CPE. Just a reminder, you do have to answer all the polling questions in order to get CPE credit. So we're going to go 5 more seconds. 5, 4, 3, 2, 1. All right, Mariah, close that poll. Let's see what we got. Well, we're all over the board. So luckily, I mean, I could not say this if I was doing it for our big clients, but I'm doing it for myself, so screw it, I'm going to say it. We're all over the board, and obviously, not everyone got it. But we'll use this to debrief. Do we have to calculate impairment each reporting period? The answer to that is no. We don't have to calculate it, but we do have to qualitatively assess whether impairment is present. If it is, then we need to calculate it, but we don't have to calculate it each period. So that answer was wrong. We must measure the investment at fair value. Now, in fact, the whole point of the measurement alternative is that is not fair value. It's kind of a fair value-esque thing, less impairment plus or minus observable price changes, but it's not fair value. We must conduct an exhaustive search. No, you don't need to search the ends of the earth to find them, but you do need to take your blinders off. So you don't need to conduct an exhaustive search. The correct answer was this. It's the last one. You must stop using the measurement alternative if readily determinable fair value is available or NAV as a practical expedient is qualified for. Okay? All right. So this is applicable, or this ASU 2016-1 is applicable for public business entities now.
Okay, well, we've got a few revenue-related issues we want to talk about. Now, we already disclosed that ASC Topic 606 is not part of this training. There were a bunch of ASUs that came out that sort of amended to ASC Topic 606. Those are not included either. These are actually 3 that are sort of standalone. Okay, they are related to revenue. They're related to 606, but they're sort of standalone guidance. And the first one that we want to talk about is related to recognition of breakage for certain prepaid stored value products. Well, that is quite a mouthful. What are we talking about here? We're talking about gift cards.
I hate those things.
You hate gift cards?
Well, yeah, because my dad, well, sorry, Dad. My dad will usually, I mean, it's always the same gift card.
Right.
It's $50 to Cabela's for my birthday,
right,
or Christmas.
Well, that sounds pretty good. It's a good restaurant, right?
Cabela's is not a restaurant. It's a sporting goods store.
Sporting goods store. Okay.
No, but here's why I hate them. Because he ends up giving them to me, and then I put them somewhere, and then I never use them.
So it's not that you hate sporting goods. You just never use the card.
Yeah, and I forget I have them.
Right. All right. Well, and that's the issue that we're talking about here. $50. I mean, that's a little.
My parents don't love me as much as they love you, I guess. Well, I'm not an only child. This guy is. Right?
Okay, there, fair enough. But the issue that Mike brings up is actually the issue.
I'm sorry, I shouldn't have done that to you.
Okay. The issue that we're talking about here in this ASU, and that is breakage. And breakage means when a gift card, prepaid card, goes unused. Okay. Right? So think about it from the perspective of the retailer, right? And yours was
Cabela's.
Cabela's. All right. So think about it from Cabela's standpoint. They have received the cash of $50 from your father and issued the gift card. Okay. You theoretically are going to redeem it for products. So Cabela's debits cash and they have to credit a deferred revenue account.
Some sort of liability.
They haven't satisfied the performance obligation yet, right? They only satisfy that when you come into the store, you exercise that gift card and you actually get some product, right? So the issue is, well, what happens if that gift card goes unused, right? In your case, you've lost it, you threw it in a drawer. You know, at some point in time, Cabela says, all right, how long is long enough? Can I just pull this off my books and recognize the revenue that I'm entitled to? And that's what our little example here is talking about. This was dealing with cookies and a controller here who says, hey, I got all these gift cards that have gone unused. When can I actually, you know, recognize the revenue? Okay. And so this ASU came out to talk about that. And basically what it said is, if you expect to be entitled to breakage, and what we mean there is you're always legally entitled to it. That's a very important caveat. But you expect that there will be breakage. X% of these gift cards go unutilized, for example. Then you can actually start recognizing the breakage, meaning pulling
some revenue,
the deferred revenue off and putting it in as revenue, you know, over it's a systematic method over the, you know, based on the pattern that the breakage occurs.
So theoretically, Cabela's would have an estimate that says, hey, 5% or 10% of these gift cards, you know, expire unused,
right? And
or they don't expire, because
I
know in Virginia you cannot, but they can expire,
and we'll talk about that in a minute as well. But that's exactly right. And in addition to that, they're going to know that after X number, you know, after 1 year, X% are going to go unused, and they're going to have a lot of statistics on that. And they're going to use that to recognize the revenue. Now, a lot more guidance in the standard, but that's kind of the gist of what's going on. Okay. Now, if the now very important, and this is the interaction with ASC topic 606. The company can only de-recognize the liability to the extent that it's probable that a significant reversal of that recognized revenue will not occur in the future. Okay, and this is the revenue constraint concept that's built into ASC topic 606.
And we talk about, when we give ASC topic 606 training, we talk about the revenue constraint when we're talking about valuing variable consideration.
Exactly. It's the let's not get too crazy clause, right? Let's not get too crazy and recognize revenue that then we're going to have to reverse.
So it's a bit of conservatism in there. You're not going to go.
It's putting sort of a limit on it,
gotcha.
Right? And that same constraint is applying here with the recognition of breakage.
Okay.
Now, if the entity does not expect to be entitled to breakage, meaning, you know, they expect that these are all going to get exercised, well, then we don't recognize revenue. Of course, when the card is exercised, we would, but otherwise we don't recognize revenue until the likelihood of the card being utilized becomes remote. So it's pretty high threshold.
So if they don't have any history or whatever, then we wait till it's remote. Basically, it's a done deal.
Exactly.
Okay.
Exactly. So that's what it's based on. Now let's take a look here at a little bit more of the details related to this. Now, what this standard did is say, hey, these items are, you know, financial liabilities, basically. Okay, these are financial liabilities. The deferred revenue is a financial liability, but the ASU gives us a little scope exception from the normal financial liability guidance and derecognition guidance. It says, let's try and follow a model a little bit closer to ASC topic 606, and that's what they've put out and brought that revenue constraint in. We've already talked about what breakage means, but the other thing that I want to mention is scope. This relates to cards that are redeemable for product, or even traveler's checks, because theoretically they're redeemable for product. It does not apply to cards that are redeemable for cash. So like those Visa, you know, cash cards that you get sometimes.
I hate those too.
I'm sure, because then you lose them.
Yeah, right? and actually with that's a crock of, you know what, because they end up diminishing in value over time.
That's right.
And so poor grandma gives you $100. Grandma loves me. She's giving me $100. And then all of a sudden, you know, I go to redeem and it's only worth 80.
We'll talk offline about your organization and maybe a way that you can keep these cards. But it doesn't apply to the cash cards. It also doesn't apply to customer loyalty programs. So airline miles, hotel points, things like that. There's guidance in 606, AC topic 606, specifically related to those. It also doesn't apply anytime these cards have to be remitted, or the value has to be remitted under unclaimed property laws. And that's based on the laws in the individual state in which you do business.
Okay.
Effective, it's effective. Actually, the same effective date as AC topic 606.
So public business entities right now.
Year, right.
Okay. The next ASU we're going to cover, ASU 2017-5, deals with derecognition of non-financial assets. And we have a class example on the screen, but rather than us going through the boxes, Mariah, didn't you create a cool little video for this that she did? So let's look at Schifrin, Vaughn, and Mancuso.
Let's take a look at an example to see how the derecognition of non-financial assets changed as a result of ASU 2017-5. Schifrin owns 100% of Vaughn, a consolidated subsidiary. Vaughn holds title to land with a carrying amount of $5 million. Schifrin concludes that the land is not an output of its ordinary activities within the scope of Topic 606, and that Vaughn does not meet the new definition of a business. Schifrin enters into a contract to transfer 60% of Vaughn to Mancuso for $6 million cash, which is due at contract inception. After the transaction, Mancuso has a controlling financial interest in Vaughn with its 60% ownership. Assume that the fair value of the 40% interest retained by Schifrin is $4 million. How much gain, if any, should Schifrin record as a result of this transaction? Under the previous guidance contained within ASC subtopic 360-20 related to sales of real estate, entities were required to defer gains when certain indicators were present. Even if these two indicators were not present, this guidance generally required partial gain recognition because any non-controlling interest retained by the seller would be measured on a carryover basis. ASU 2017-5 eliminates subtopic 360-20. As a result, sales and partial sales of real estate assets will now be subject to the same derecognition model as all other non-financial assets found within ASC subtopic 610-20. This guidance requires entities to apply certain recognition and measurement principles found within ASC topic 606 when they derecognize non-financial assets, even when the counterparty is not a customer. Under ASU 2017-5, an entity that transfers a non-financial asset to a customer follows the following steps to determine whether to derecognize the asset. First, the seller evaluates whether or not it has a controlling financial interest in the buyer using the guidance found within ASC topic 810. If yes, then the entity does not derecognize the asset. However, if the seller does not have a controlling financial interest, then it must evaluate whether a contract exists and whether the buyer has obtained control of the non-financial asset that was sold in accordance with the principles within ASC topic 606. Let's look back at our example to see this guidance in action. In our example, Schifrin concludes that it no longer has a controlling financial interest in Vaughn, as it has only retained a 40% interest. Furthermore, it does not have a controlling financial interest in Mancuso, the buyer. As such, Schifrin moves on to Step 2. In Step 2, an entity must evaluate whether a contract exists using the criteria found within ASC topic 606. These criteria are being listed on the screen. In our example, Schifrin determines that the contract meets these criteria. Step 2 also requires an entity to determine whether the buyer obtained control over the non-financial asset that was sold. Because Schifrin continues to have a non-controlling interest in Vaughn, Schifrin evaluates the point in time at which Vaughn, its former subsidiary, has control of the distinct financial asset. Therefore, Schifrin will use the control transfer criteria found within ASC topic 606 related to performance obligations satisfied at a point in time. Schifrin concludes that it has transferred control of the distinct financial asset because Vaughn controls the distinct financial asset. The ASU requires the seller to recognize full gain or loss when these derecognition criteria are met. The gain or loss is calculated as the difference between the consideration received and the carrying amount of the asset sold. Schifrin derecognizes the land and its controlling financial interest in Vaughn and calculates the gain or loss as follows. The amount of consideration is $10 million, which includes $6 million in cash, plus the $4 million related to the fair value of the non-controlling interest in Vaughn. The carrying value of the land was $5 million. As a result, Schifrin recognizes a gain of $5 million. Schifrin will also record the non-controlling interest in Vaughn at $4 million and subsequently account for that interest, most likely in accordance with ASC topic 323 as an equity method investee.
Okay, well, As you can see, there was a lot of details in that video, and a couple things I just want to point out before we move on. First of all, these videos will be available to you on YouTube, on our YouTube channel. They're not posted yet, but within a few days after the training, we'll get those posted up there if you ever want to go back and take a look again.
And we're doing a lot of these type of
We are.
videos.
There's others up there, and we're going to keep adding them. But anything related to this training will be up there in the next few days. Now, you can see there's a lot of details going on. And there's a lot of details in this standard. So if this applies to you, you're going to want to take a look at it. There is a flow chart in the back of the ASU that's really helpful in navigating these questions. For example, in our example, we gave up controlling interest and we met the transfer of control indicators in ASC topic 606. If we hadn't done that, the answer would have been different. We wouldn't necessarily have had that full gain recognition. So this is kind of a big deal for the real estate industry, and it has a pretty significant impact, including the retained non-controlling interest in the transaction price, as you saw in the video, at its fair value, results in the entity recognizing 100% gain on the sale of the asset. It's a big change from current GAAP, where partial gain recognition was common for partial sales of real estate. In addition, the new definition of a business that Mike spoke about earlier will result in less sales being classified as businesses, and that will also mean this ASU will have a more significant impact on the real estate industry. All right, and again, just a summary of what we just spoke about. This is effective for public business entities this year. Last one related to revenue recognition. This is pretty narrow, but I do want to mention it to you. It's really dealing with service concession arrangements. It's ASC topic 853, which has actually been around for about 4 years now. ASC topic 853 gives guidance on service concession arrangements. Well, what exactly are we talking about here? This is an arrangement that involves a contract under which a public sector entity, who we'll call the grantor, grants a private entity, an operator, the right to operate the grantor's infrastructure for a period of time. So, you know, maybe we're talking about a hospital, a toll road, an airport, a prison, something like that. So they've basically engaged government has engaged a private entity to operate and potentially make capital improvements to, or even maintain that asset. If we take the example of the toll road, you know, we'll think through that here in just a minute. This is the definition of a service concession arrangement that we just mentioned. The issue with the ASU that's come out, the ASU that has come out addresses, is who is the customer? Okay, who is the customer for that private entity operator? Who is their customer? Why is this a big deal? Well, the private operator is collecting revenue, and they need to know when to recognize that revenue under the criteria in ASC topic 606. You only recognize revenue when you've satisfied your performance obligation. So who your customer is makes a big difference, because have you satisfied the performance obligation to them? Take the toll road, for example. You know, the private entity operator collects tolls from the driver. They get them as they drive across the road. Well, if the driver is the customer, then as soon as they drive across the road, the performance obligation is complete and the operator should be able to recognize revenue. If it's the public sector entity who's the customer for the operator, then it might be at a different time, because they may have other obligations to that grantor, like maintaining the road and doing various other activities. What this ASU has done is clarified that the public sector entity, the grantor, is always the customer to the operator. And that will have a big impact on when and how much revenue gets recognized. So a lot of backstory just to cut to the chase here and say it's the grantor who's always the customer.
Perfect.
Okay. This is the same effective date as ASC topic 606. So time is now for public business entities.
Okay. So with regards to the next ASUs, the next bit is related to derivatives and hedging. The first one, ASU 2016-5, deals with novations. Now, if you're doing hedge accounting, you do stop at certain times. Mm-hmm. You got to stop when you no longer qualify for hedge accounting. I know that. Can you stop if you want to? Yeah,
sure.
It's an election. You can always stop. If you're a cash flow hedge, you need to stop if in your hedging a forecasted transaction, you need to stop if that forecasted transaction is no longer probable. And you also need to stop, the first bullet up there, if the hedging instrument expires or is sold, terminated, or exercised. So once the derivative, the hedging instrument is gone, you need to stop hedge accounting. Now, The question comes up is, what about novations? Now, a novation really occurs, when the counterparty has been substituted. This might happen if there's an acquisition. I'm entering a derivative instrument with Wells Fargo. Wells Fargo gets acquired by JP Morgan. My new counterparty is JP Morgan. The question is, does that mean that because that derivative counterparty is different, does that mean that this derivative has been terminated, which means I need to stop hedge accounting? That's the issue dealt with by this ASU.
And we all know that the hedge accounting rules are pretty strict, so I can see why this issue would come up, or this question would have come up.
Yeah, exactly. And what this ASU basically says is that ASU 2016-5 says, hey, the novation in and of itself does not require you then to stop hedge accounting. Okay, so just because you've had a novation doesn't mean you automatically, have to stop.
JP Morgan acquires Wells Fargo. Everything's all the same, except the counterparty is now different.
Yeah, except, and this is very important, you have a different counterparty.
Right.
And you always need to assess counterparty credit risk.
Okay.
When dealing with derivatives, not only for the fair valuation, but also, the fair valuation, and then when you determine effectiveness. And so if you have, in other words, if it's Wells Fargo and JP Morgan, you're probably all right. But if it's Wells Fargo and GAAP Dynamics Bank, not to dog our own company, but, that's obviously a different credit risk. Right. And that might whack you out of derivative account or hedge accounting, because now you're no longer going to be effective.
So you may have an indirect effect from the novation that could disqualify you from hedge accounting, but the novation itself, in and of itself, is not a problem.
They're fine. So that's pretty easy. This is effective this year for private entities. The next ASU we're going to do, let's see, a polling question. So here is the next polling question. I'm going to read it out. We had a question that maybe can't be seen by everyone. So I'm going to read the question here. Which statement is true regarding hedge accounting under U.S. GAAP? Select one of the following. Which statement is true regarding hedge accounting under U.S. GAAP? Remember, you do have to answer the polls to get CPE credit. Remember, you do have to answer all of these CPE, and I think we have 6 polling questions. I think you need to answer 5 of them for an hour and a half, 1.5 CPE credit. So please answer the polling questions. This polling question will close in 10, 9, 8. I won't bore you with my countdown. 5, 4, 3, 2, 1. Get it going. All right, so let's see what we have here. Okay, so which statement is true regarding hedge accounting? Not permitted to designate. That's false. You can always de-designate if you want to. Not required to assess creditworthiness of the counterparty. That is false. You always have to assess the creditworthiness of the counterparty to measure effectiveness and to value the derivative, to be quite honest. The correct answer was C, or the third one. You aren't required to stop hedge accounting upon novation. You might have to stop hedge accounting if the counterparty credit risk is vastly different, but you're not required to automatically stop. And not permitted to discontinue hedge accounting. You're always permitted to discontinue it. Okay, so let's move on. There's the next ASU related to derivatives, relates to contingent options and debt. And I'll just I'll be a little quicker here because I don't know how applicable this is. Golden Financial issues a debt instrument at par for $1 million. The instrument is for a term of 10 years and pays a fixed 5% interest. Also embedded within the instrument is an option for Golden to buy back the bond at 105, but only if the price of gold at the exercise date exceeds $13.50 per ounce. Price of gold currently is $1,200 per ounce, so it does, it hasn't kicked in yet. So it's a contingent call option. How should Golden Financial account for this debt instrument? Well, When I first looked at this question, I said, excuse me, there's an embedded derivative in there, and the price of gold is not clearly and closely related to a debt. Why? Because it's not interest related or creditworthiness related. And that's the way some people were thinking about it. However, a while back, and I'm dating myself here, the DIG, the Derivatives Implementation Group, provided a 4-step interpretive guidance for this. And basically, if you jump through the hoops on this class discussion, you'll see step 1 is the settlement amount based on changes in an index. Yes. Step 2 is the payoff indexed to an underlying other than interest or credit. Well, yes. But there's a step 3 here. Does the debt involve a substantial premium or discount? Now remember, the premium that I had to pay to call it was only at 1.05 million. That probably is not a substantial premium, and therefore the answer is no. If no, then they've said, or the FASB, the DIG, said that it's clearly and closely related. You don't have to bifurcate. So that's really the issue here is, which do you follow? Do you follow kind of the overwhelming guidance of not clearly and closely related, or do you follow this 4-step model? And this ASU said you follow the 4-step model. Okay? And this is applicable for all other entities. Now, public business entities, it's already been effective. Okay. Next, it's Q&A time. So we've been answering some questions. Is there any that we haven't answered to people, Mariah?
Not right this second.
Okay, so a few things. So if you do have questions, at different points, we'll stop, we'll answer the questions. If we don't answer it or we don't get to it, we go to webinar actually populates a question for us, and we will put all the questions, make them public, the ones not related to technology, but the ones related to accounting. And we'll publish that and give it to you with your CPE certificate. Also, I wanted to mention, you have the handouts out there, the slides that you can actually download. And all those little class discussions that we've been going through, we'll also give you a solutions deck for that as well. And we'll give that to you via email when we send you your CPE certificate. Okay. Moving on. Share-based payments.
Okay, well, we've got a couple of ASUs to talk about related to stock compensation and share-based payment awards. And the first one actually deals with a number of issues. And you can see the title, Improvements to Share-Based Payment Accounting. And that's good. These actually are quite helpful to try and alleviate some of the more burdensome accounting. They also had some other interesting effects, particularly this first one. Facebook, this is an article from the Wall Street Journal. It was at the beginning of 2017 talking about Facebook's 2016 earnings release. Facebook enjoys a nearly $1 billion tax windfall from an accounting change. Wow. So we've got headline news related to an accounting change, and it had an impact of $1 billion on Facebook. That's kind of crazy. It says more specifically, their 2016 earnings got a boost of more than $900 million from an accounting change. And the same change could help lift earnings at other technology companies, and it did. Okay, so let's take a look at how this all worked out, and this will help illustrate how this impacted Facebook, but also our change under this ASU. This specific change, and there's a number of others we'll talk about, is dealing with taxes. Okay, so share-based payment awards generate temporary differences, and here's how it works. And for those of you not from the U.S., please note that this is what we're talking about here, kind of based on how it works under U.S. income tax law. It may be different in your jurisdiction, might be the same, but in the U.S., a deduction related to the share-based payment award that we're issuing does not take place until the exercise date for the stock option or the vesting date if we're talking about shares. In addition to that, the deduction is most often based on the intrinsic value of the award. Now, that's
at the time of exercise.
Exactly.
Okay.
That's the intrinsic value at the time of exercise. So whatever that value is driven by the market price at that future date.
So if I give you some stock options, you exercise in 5 years, whatever the stock price is 5 years from now is what the deduction will be for the company.
Exactly.
But now let me ask you a question, but that's not the same accounting under GAAP, is it?
No, under GAAP, and that's on the right-hand side of the screen. We're starting to talk about it here. We are going to recognize compensation costs based on the fair value or the grant date fair value of the share-based payment award. That's calculated up front. Okay, so it's sort of a set for an equity classified award, it's sort of a set it and forget it kind of thing. We calculate that drives our compensation costs. We're going to recognize that over the service period, a lot of times on a straight line basis. And this compensation cost will drive the recognition of a deferred tax amount, a deferred tax asset related to this ultimate deduction that we're going to get. But here's the problem. Those numbers are not going to be the same. When we finally get the deduction and it's based on the future value of the stock, that's not going to be the same as this deferred tax asset we've accumulated, which was based on the compensation cost, which was based on the original grant date fair value of the award. So there are always going to be differences when we settle. And that's what this screen is going to start to get at, is how do we account for these differences? If we have excess tax benefits, and what that means is, we didn't record enough of a deferred tax asset and the actual deduction is much higher. Mm-hmm. What that means to me is the stock price went up. Yep. Right? If that's the case, current GAAP says, you can't recognize that difference in the P&L. No, sir, you've got to recognize that in additional paid-in capital. You got to kind of store that gain away. And it may be an additional paid-in capital. It could be in there forever.
That's called the APIC pool?
The APIC pool.
Okay.
Now, if you have a tax deficiency, meaning your actual deduction is lower than the accumulated deferred tax asset,
because the share price
has gone down, not APIC there, we're going to take that right through the P&L as a loss. Okay.
So that sounds like a pain to actually, for all the different tranches, to kind of figure that out.
It is. And the reason why it's a pain is because we're going to take that tax deficiency through the P&L unless we have historical amounts in the APIC pool related to excess tax benefits that occurred for other share-based payment awards in the past.
So it's a lot of bookkeeping.
It's a lot of bookkeeping.
But isn't it gone?
It's gone.
All right, that's good.
All right, so the good news is this. ASU 2016-09 says, hey, look, all deferred tax, excess tax benefits and tax deficiency, all that stuff, all that true up at the end, okay? The accounting during the period is the same, but all the true up there at the end goes right through the income statement. Now, what does this do? It creates some volatility in the P&L, but it does make the accounting easier. Speaking of volatility in the P&L, that's what happened with Facebook, but it was positive volatility for them. They had an almost $1 billion windfall. How did that work? Because I see down at the bottom that transition to this is prospective, and you would think that that was because of the transition to this.
And you would have thought that that would have gone to opening retained earnings and not income.
Right. What happened with Facebook, they early adopted this standard, by the way. So they adopted it in 2016, which was totally cool.
I wonder why.
And the reason why they did is they had a tremendous number of stock options that were
about to be vested or
exercised by the end of 2016. And as you know, Facebook's stock price soared, from the IPO. And so they had a huge amount of in the money options that were being exercised. And that's what created that $1 billion, positive hit to the income statement. Okay. So timed well. And we had some other tech companies that early adopted to take advantage of the same thing. Okay. ASU 2016-09 did a lot of other things besides just the tax benefits. That's just kind of a crowd pleaser because that was kind of an issue from an accounting perspective. The other one is dealing with forfeitures. And as you know, historically, we are required to estimate forfeitures of awards in the future, and we'll take that into account.
And then you true it up each period?
Yeah, as we're accounting for the award, and we'll true it up each period. What the ASU says is, if that's what you've been doing and you're happy with it, by all means, keep on, right? You can do that. But they have another accounting policy election they've added that says, hey, look, you can recognize compensation costs in full and then just reverse the compensation costs when the awards are actually forfeited, okay? Rather than doing the estimate. Choice is yours. It's an accounting policy election.
Be consistent.
Exactly.
Okay.
Another change we'll talk about here, but a quick reminder before we get into it, classification of awards. As you all know, anybody who deals with share-based payment awards, one of the biggest decisions we have to make or determine is my award equity classified or liability classified? Big difference from an accounting perspective, because equity classified awards, sort of a set it and forget it. We do the grant date fair value thing. We recognize compensation costs across the period. Liability classified awards are remeasured to fair value every period, and that has a big impact, on the accounting. So this slide here, we're not going to get into all these details, shows all the things that could cause liability classification. the bottom line is cash is king here, right? Anytime there's settlement in cash or even potential settlement in cash, in some cases, we end up with liability accounting. The change is related to a box that's kind of in the middle. It's dealing with tax settlement. So what a lot of companies do when they issue share-based payment awards is they actually withhold a certain number of shares and convert those into cash and remit that to the taxing authorities. It's withholding.
Because Zuckerberg might not have 40% of $1 billion ready to pay the IRS.
Exactly. So Facebook will withhold that amount.
I'm playing my little violin for him. Yeah.
And remit that to the taxing authorities. The problem is the old guidance said in order to avoid liability accounting, because we do have a partial cash settlement there, that settlement had to be based on a minimum statutory rate, the minimum tax withholding. That's not what companies were doing. Most companies, because they don't want to try and guess what their employees' tax rate is and all that, they were just withholding at the maximum statutory rate to make sure that there were enough withholdings out there to satisfy the tax obligation. That's where the changes come in. The FASB has now said, oh, okay, that makes sense. We're going to allow you to withhold at the maximum individual statutory rate, and you can still avoid liability accounts.
So 35, 30, whatever the new one is.
Exactly.
Okay.
ASU 2016-09, we talked about the 3 items here with check marks next to it. There are a couple of others for non-public business entities that are particularly important if you're a non-public business entity. And one allows you to have a practical expedient to determine the expected term of certain share-based payment.
And that practical expedient is probably just the midpoint.
It's taking the average or the midpoint of the term to calculate the term, and just making a little bit simpler accounting. So take a look at that.
And I like the last one here. They basically said non-public companies cannot use grant date fair value, but can use the intrinsic value as the measurement basis for liability awards.
Way easier, but be careful with that one, Mike, because it is only available. It's a one-time option.
Yeah.
It's available when you adopt this ASU. You can elect it, and you're good to go. But if you once you've adopted this ASU or the adoption date is passed, if you haven't elected it, then you can't do it in the future.
Then you're always going to have to remeasure that liability award.
Exactly. It's a one-time.
Well, and this is applicable, in right? This is non-public entities right now.
Yeah, let's take a look at that. It sure is. So this is the time.
Okay.
One more related to share-based payments, and this is a short, well, it's not short and sweet if you deal with modification accounting, but we're going to keep it short and sweet here. The guidance, there's a lot of guidance on how to account for a modification to a share-based payment award. So it's an award that's been issued. We've made some change to it and somehow modified the terms of the award. If it qualifies for a modification, there's specific accounting guidance you have to follow. The question is, what is a modification? And here's where we've had our change under the ASU. It used to say a change in any of the terms or conditions of a share-based payment award is a modification. Some people felt like that was kind of broad. And so what the FASB did is they came in and struck out those 2 words, any of. You see those crossed out on your screen. So now a modification is a change in the terms or conditions of a share-based payment award.
Oh, well, that's it.
Gee, thanks, right?
Yeah.
I mean, is that helpful? Well, in addition, they added what's under the second bullet here. They added some criteria. And basically what it says is you have a modification unless you meet all of these criteria. And if you read these, I'm not going to read them for you, you'll see that it's basically saying, things haven't really changed all that much.
Okay.
So we got a little more clarification there. Okay. Oop. Again, this one is effective well, the time is now for everybody, right? There's no difference between public and
I think it's time for the next polling question.
I think that sounds good.
Okay, would you launch that for us, Mariah? So, this is sort of a test the polls, which ASUs covered thus far in these areas do you expect to have the greatest impact on your organization or clients? Business combinations, financial instruments, the revenue-related issues, derivatives and hedging, or share-based payments. Make your selection, and remember, you have to do this for CPE. Just a reminder, we got you need to select the poll or answer the polls for CPE credit. And the poll is closing here shortly, so put in your answers. All right, Mariah, we'll close that poll. Okay. The good news is, I mean, the revenue-related issues obviously is the clear winner, but it looks like, you know, we've gotten a little bit of something for everybody.
Hey, we got to vote on derivatives and hedging. Good job, Mike.
not very much. So anyway, oh well, I don't take it personally. All right, we're on the home stretch now. We have 4 ASUs left. They deal with they're quick ones. That's the good news. So a couple on presentation. The first relates to not-for-profit financial statements, and some of the changes are up here. So if you deal with not-for-profit, just know that this ASU is out there and is effective for you currently this year. Now there's only 2 classes of net assets instead of the 3. You're going to have net assets with donor restrictions and net assets without donor restrictions. There's some changes related to how you kind of report investment return. You're going to report it net of external and direct internal investment expenses. There's been some changes in the presentation of expenses. You have to now do it by nature and function. That could not just nature or function. And so, you know, nature is things like, you know, salaries, rent, or whatever. Function is, you know, by program activities and support activities. And so you have to do it by both function and nature, which could be kind of a pain. You're still free to choose the direct and indirect method for cash flows, but you no longer have to kind of reconcile that. But probably the biggest change is these qualitative and quantitative disclosures about liquidity and available resources of the not-for-profit. So if you deal with not-for-profits, you probably already knew this was applicable this year. If you don't deal with not-for-profits, you just want me to move on to the next thing. So there you go. The next presentation thing deals with net periodic pension cost. Under U.S. GAAP, net periodic pension cost is composed of the following components, and you see that on the screen. And usually these were all sort of netted, so it's a net amount. And under current guidance or previous guidance, this was all sort of below the line. It's out. Oh, no, I'm sorry. Liar. I'm a liar. All of this was above the line. All of this is the same place where salaries was. And people didn't like that because, you know, we got things like actuarial gains and losses. You got things like interest costs, you know, the unwinding of the discount. That was above the line. And they say, this is finance costs. This should be below the line, outside of operating income. Well, the FASB has heard you. And they said, from now on, the only thing above the line, the only thing in operations is going to be service cost. And that's going to be above the line. Everything else is going to be below the line. But be careful. The problem is that now only service cost is going to be eligible for capitalization. So if you capitalized salaries and pension cost for inventory production or self-constructed PP&E or things like that, now only service cost is going to be able to be capitalized. Okay, so this is applicable this year for public business entities. So let's take a look at our next polling question. Which of the following components of net periodic pension cost would be included within operating income in the P&L? How we doing out there?
87%.
87%. So get your polling question answers in. It's about to close. So get your final answers in. For CP, Mariah, why don't you go ahead and close the poll? Let's see what we got. 70%. Wow, that makes me feel good that 70% got the correct answer. It is service cost. Everything else is outside of operating income below the line under the new ASU. Okay, Chris, it looks like, now I don't know, personally, which do you like better? Taxes or cash flows?
Oh, I don't know.
Because both of those actually you quite enjoy.
Yes, that's a tough one. Well, let's take a look at this and maybe we'll see what the audience thinks. But we actually have two ASUs that have come out related to the statement of cash flows. And it's interesting because statement of cash flows, the guidance for that has been around for 20 plus years at this point, probably more like 25, and hadn't changed a whole lot over time. Why are we seeing guidance come out after all these years on the statement of cash flows? Well, there is gray area in the guidance. So even though, we have three categories: operating, investing, and financing, sometimes we have transactions that it's difficult to determine what classification, how they should be classified. And sometimes we have transactions that have attributes of multiple classes. And what do we do there? Part of the genesis of this new guidance too is that the statement of cash flow is quite important out there in practice. It's very important to investors, to analysts, even to bond rating agencies, things like that. We're seeing an uptick in the number of cash flow metrics that are being utilized by analysts and rating agencies. Investors seem to migrate towards the cash flow statement. And the reason for that is the balance sheet, well, it's great, but it's static, right? Static data. The income statement, well, that's got a lot of arbitrary non-cash allocations in it, depreciation, deferred this and all
accruals,
that. And right. So that gets challenging. And for the investors, they really like the cash flow statement because it nets all that stuff out.
And they especially like operating cash flows, don't they?
That's what they really want is, how much cash is this business spinning off, and is it enough to satisfy the obligations that are
So you're
out there?
saying that, if I'm a company and I have, there's some gray areas to what this cash inflow is, I might be tempted to jam it in operating cash flows rather than investing in financing. And if it's a cash outflow, just the opposite. I probably want to get it into investing in financing, not operations.
Exactly. And so at least for what we'll see here, 8 specific transactions or areas, the FASB has provided explicit guidance under this ASU about how they should be classified. Now, we're just going to give you a little taste, and it's the 2 with the check marks. If you have zero coupon bonds, or you have a debt prepayment or debt extinguishment, take a look at the ASU. It's going to tell you exactly how to classify the payments or the cash receipts related to those. But just for fun, let's take a look at the 2 with the green checks, give you a little flavor for what's going on. This first one is dealing with insurance proceeds, and we have Ring of Fire here. They produce fireworks at each of 7 factories, and they had an accidental fire in one of those factories, and it, of course, burned to the ground very quickly. A lot of explosions. We're dealing with fireworks. Well,
do you want me to sing Johnny Cash right now?
You could.
No.
but it destroyed. That would be fun. It destroyed the building. It destroyed the equipment.
Yeah.
It destroyed the inventory. It's all gone, burned to the ground. So they received a check from the insurance company, a lump sum payment, but that check was covering the building, the contents, which is the equipment and the inventory, and also provided some business interruption insurance because, of course, this was, a big deal for them and really disrupted their business. The question is, how should they classify this cash inflow, this cash receipt, in their statement of cash flows? And what the answer here is it's actually multiple classifications. And so what they say is look, you got to take this single cash flow and separate it out in this case and say, okay, well, a certain amount is related to the building. Well, that's an investing cash inflow, because even though it says in the facts here that they're not going to rebuild the building, it's like they sold it, basically, right? Anytime we have a purchase of a building or sale of a building, something like that, that's always an investing cash in and outflow, and it's no different here. The cash receipt related to the inventory, well, that's operating because it's inventory. Same thing with the business interruption insurance. It's operating because it's related to the operations of the company. But bottom line is we're going to separate that out. Okay? So this is a nice general one to kind of illustrate what some of these considerations are. So is this next one on predominance. And this is Bird on a Wire. They purchased several used aircraft engines to use for parts. But when they got them, they realized they still had some useful life left in them. So they decided before we strip them and use them for parts, we're actually going to, and they would use parts for their own purposes. They decided they're actually going to lease the engines out to other companies for a little while until their useful life is used up. So kind of get, a little extra bang for the buck on these aircraft engines. So how should they classify this?
Well, I'd like to do a polling question here and see what the audience thinks.
All right, let's try that.
So Bird on a Wire, what do you guys think? How should the cash outflows to acquire the used aircraft engines be classified in the statement of cash flows? Operating, investing, financing, or not enough information? about these polling questions, Chris, is number one, there's no right or, well, this one especially, there's no right or wrong answer.
Well, because we haven't
potentially.
told you yet.
We haven't told you yet, but go ahead and get that in. Mariah says we're at 90-some%. So Mariah, last chance, last dance, last chance for romance. No, that's Donna Summer. Sorry.
Okay.
Go ahead, close that poll. We're done. All right, so we're all over the board, Chris. We are all over the board.
Well, that's
operating. We got operating, investing, and then we got the other third is financing or not enough information, or I'm hungry because it's 12:30. We only have a couple more minutes. So
yeah, we do.
Hang with us.
Hang in there. I know we're running a few minutes behind, but we're getting right towards the end. Now, the good news about this polling question is, well, the answer actually is it depends. So nice job. Everybody, I guess, got it right.
Everyone's a winner.
All right. Well, what does it depend on? If the aircraft engines were purchased solely to be used for parts, then operating would be the appropriate classification. We're using them in our operations. If they were purchased solely to be leased out to other airlines, then investing would be the appropriate classification, because that would be an investment that we're going to make a return on. The issue here is that this cash flow outflow has multiple attributes. In this situation, we've got to apply judgment to determine what the predominant attribute is to determine the proper classification. Again, if the main purpose of the acquisition and the main source of cash was to use them as spare parts, then operating would be the right answer. If the main purpose and main source of cash was to lease the engines out, then investing would be the appropriate classification. ASU 2016-15 that we're talking about here provides some clarity to these types of situations, because there's a lot of diversity in practice. And basically what it does, it says sometimes we got to separate out the cash flows like we did with our insurance example previously, but sometimes, and in this example is probably the case, you wouldn't be able to attribute some of the cash to one and some of the cash to another classification. In this example, we're gonna have to look at what the predominant source or use of cash is. And so the ASU provides us a little bit more of a framework on how to do that. Okay, we need a little bit more information here to make a full determination.
So I would go back to that slide, and if you have one of those 8 types of cash flows, check out the ASU to get more.
Absolutely.
Okay, so this is applicable for PBEs, public business entities, this year, right?
Yep.
Time is now. Last one, Chris.
Last one is restricted cash, and you can see we're showing a balance sheet here with a line item of restricted cash. Well, the question is, how should any change in restricted cash be classified in the statement of cash flows? Prior to this ASU coming out, there was huge diversity in practice. We actually would see it as operating, investing, financing. It was all over the map. And so what the FASB has done is said, wait a minute, actually, it's none of the above. Okay, it's not operating, it's not investing, and it's not financing.
It's
cash. Right. So restricted cash becomes part of that beginning of the year cash equivalents, and now restricted cash that we reconcile down to the end of the year cash equivalents, and restricted cash. So it's part of the opening and closing number. Okay, so it's nowhere in the statement. What this means, though, is that if it's not clear from your balance sheet the makeup of what's in the what you're reconciling in the statement of cash flows, you do have to provide disclosure that shows cash equivalents, restricted cash, just so it's clear what's in that number.
perfect. All right.
Oh, and again, this is effective now for PBEs.
Perfect. All right, Mariah, last chance for questions. Any questions?
Not right this second.
We are good. So if you have questions, again, you can always reach out to Chris and I after this too.
Sure.
Send us an email. I believe the slide deck had our emails. You can go on our website, gapdynamics.com. Last little bit, humor me for 30 seconds. We're about to launch an online learning platform. This learning platform will have e-learning. It'll have some of these micro-learning videos. It has all our blog posts, and that's going to be launched in the next, couple months, right? And we're doing that now. Mariah has produced a little, we call it a micro-learning video. Now, this is more of a sort of an introduction to this revolution. I think it's only 2 minutes. Mariah, if you play that, and then when we come back, we'll actually wrap up the course and tell you the next steps.
Being a CPA is hard, demanding clients impossible deadlines, and a workload that at times is overwhelming. Unfortunately, maintaining your CPE often falls to the bottom of the list. You could attend an open enrollment course in some cool location, but that means expensive travel, not the most efficient use of your precious training dollars. Or there's the glut of CPE companies out there promising unlimited CPE for some outrageously low price. You don't even have time to get 40 hours of CPE, let alone 400, and you definitely get what you pay for. Or there's the do-it-yourself method, developing training in-house. But do you really have the time? You've got more important things to do. What if I told you there's a better way? What if you could take charge of your professional development, designing learning paths relevant to your job? What if the training were the same as the Big Four firms? And what if this training were engaging and, dare I say, fun? Well, it exists. Powered by GAAP Dynamics, The Revolution is a learning platform that brings together engaging content and motivated learners in an online environment. Available in various modalities, The Revolution delivers high-quality training at your moment of need. And it's accessible on any device. It's your career. Demand better training. Join The Revolution.
Well, thank you for that. It was Join the Revolution, and it doesn't exist yet. It'll exist in a couple months. Anyway, wrap up. Post-course communication. So at the end of this seminar, you're going to get an evaluation sort of online. It'll go to webinar. We'll generate it. We take those evaluations very seriously, and we will try our darndest to make these things better for you. Tell us what you like. Tell us what you didn't like. You're going to get a CPE certificate. You'll get solutions to all those class discussions. You're going to get a Q&A summary. So of all the questions that were asked, we answered some of them here. We answered some of them online. And you're going to get a link to the recorded webinar. Now, the recorded webinar is not eligible for CPE just yet because we'd have to add knowledge checks and a post-course assessment. That will come later once we have the Revolution up and we're accredited by the NASBA. We could give that. But that's it. And Chris, I want to thank you. And
thank you, Mike.
But I really want to thank them for
absolutely
sticking with us.
Thank you to our audience, and we really appreciate you being here today.
Yeah, have a good afternoon, guys, and enjoy this spring weather if you're in the United States. Bye.